Hello friends, today we are going to start with the introductory session of investment. We all do investment, but why we do investment, we don't know because there are different objective for investment for all the individual. Some people just go for getting an amount of return out of their investment. Some want their risk management. Some want they should get a capital appreciation. Some looks investment as a tax benefit tool. So today we are going to discuss what is exactly investment, why an individual go for investment, what are the objectives of investment and what are the basic characteristics of investment. So first of all, we are going to start with the introductory of investment. Investment, we can say it may be a commitment of funds with the expectation of certain output in terms of monetary benefit, which we say it is a profit. Investment is the commitment or application of one's fund to one or another asset that will be held over some future time period. Means whenever we are going to do investment, we have a specific duration of investment. For that specific duration, we are going to keep money, and after that we are going to have certain amount of return out of that particular investment. Suppose if we will take an example of small FDs or RDs or bank account investment. When we go for fixed deposits, which we say FD in normal terms, we have a different tenure, 1 year duration FD, 2 years or 3 years. So that we say they are, all the investment is going to have a specific tenure for what we are going to do the investment. And whatever rate of interest we are going to get 6% or 7%, it will be the return out of that particular investment. So we can say it is a purchase of a financial product or other item of value with an expectation of favorable future returns. Or we can say in general terms, investment is the application of money for earning more money. Like we do investment in real estate also, so that we can get the capital appreciation, and sometimes we look for a rental income also, so that we can have a regular income also. So here we are just covering the introductory part of investment. So I think it will be clear to all of you what is investment. It is just putting your money with the expectation of some future output, that is a monetary benefit which we are going to do out of investment. So these are the few definitions of investment. Like if we will say according to your finance or business theories or professionals who are going to define the different definitions of investment, that is, it is a practice of investment refer to the buying of a financial product or any valued item with an anticipation that positive returns will be received in the future. Like we are going to going for a purchase of a financial product, and we have certain expectations, some amount of return, that is positive return, which we are going to get in the future date as per the tenure of investment. Or maybe investment as money utilized for buying financial assets, for example, stocks, bonds, bullions, real properties, or precious items. So investment is all about, it is going to be a basket of different financial instruments, financial securities, in which we are going to put our money with the expectation of certain future returns. Now we will see the characteristics of an investment. Like when we say investment, in each investment avenue, whether we will speak about the equity shares, preference shares, bonds, debentures, bank investments like RDs, FDs, or we will speak about mutual funds or derivatives, all have certain characteristics. So whenever we are going to go for investment, we should look for the characteristics of investment so that we can come to know for what purpose we want to go for investment. So first of all, we say risk. As we say, risk and return is inseparable part of investment, because sometimes we just want to minimize our risk. We want to go for risk management and we choose an investment option. Simple example, suppose if I am going to opt for an insurance scheme, maybe if I will go for an endowment policy of insurance, my objective is I just want to go for risk management also. If something wrong happens with me in that particular duration, amount will be given to family, or even if that scheme is going to get mature, even if I will survive, I will get certain amount of benefit. With risk management, I can have a benefit of getting a certain amount of tax also benefit also. So we say risk management means we are just trying to reduce the risk, because when we say the investment, it is going to contain the risk, because on the basis of individual profiles, like individual is going to behave like a hedger, speculator or arbitrageurs. On that basis, they are going to choose the investment option. So first characteristics is there the risk. what type of risk is going to be there in your investment option. Maybe systematic risk, maybe unsystematic risk. When we speak about unsystematic risk, the risk which can be reduced, which can be eliminated, and which may be due to internal factors. Like if you will say the operational risk, or if you will say the risk of credit, that will be linked with a specific business, that can be reduced if we are not going to have investment in that particular asset. But when we speak about systematic risk, means the risk which cannot be reduced, which cannot be eliminated, and it is due to the external surroundings or external factors. Like when we speak about foreign exchange risk, we cannot control, it depends on demand and supply. When we speak about interest rate, it is again the economic conditions which decide what will be the prevailing rate of interest under monetary policy of government. So we don't have control on these factors. So whenever we are going to choose any investment option, we see what type of risk is involved. Like when we say FDs, we say more unsystematic risk is there as compared to systematic, because the risk level is less, and that's why we are expecting a minimum fixed rate of interest out of FD. But when we say we are going to take a decision of investment in equity shares, the level of risk is too high in equity shares, and that is the reason whatever expectation investor is going to have out of that particular mutual funds or equity shares, it will be more as compared to normal FD investment. Then next characteristics, that is return. Return means whenever we are going to do investment, we always have certain return expectations. Return we can define in two forms, maybe capital appreciation, maybe in form of regular income. So what type of return I'm going to look for? Maybe I'm targeting for only capital appreciation. Suppose if I'm targeting for capital appreciation, I can choose a 5 years or 10 years FD, and after maturity I'm going to get a lump sum amount. But when I'm going to target for a regular income, maybe I can choose an option which is going to give me a regular income also. Like maybe whenever we are going to get a purchase of a real estate property, and I'm going to choose a real estate in such a form that it is going to give me a certain rental income also, and capital appreciation also. So in that, rental income is my regular income out of my investment. In equity, it may be your dividend. In bonds or debentures, it may be your coupon rate which you are going to get in form of your regular income. So what type of return you are expecting? You are expecting a high return or moderate return or low return. It is judged by the risk appetite of individual, how much risk that individual is going to take. Then next is safety. Whenever we are going to do investment, we look for the safety also. Safety in terms, if we are going to keep our money in houses, maybe it will be stolen, maybe theft chances will be there. So when we are going to put money in the bank, little bit security is there that our investment will be safe enough. Then liquidity. Liquidity, we define how easily we can convert our investment into cash. Some assets are going to be highly liquid and some are going to be not highly liquid. So on the basis of your investment objective, you are going to choose your investment option, whether you are looking for liquidity or not. Maybe if suppose I will go for a FD of 6 months, it may be going to give us more liquidity as compared to if I will choose a FD of 5 years or 10 years. Maybe if I'm going to do investments in the money market mutual funds, I'm going to have more liquidity as compared to if I'm going to invest in the growth fund of mutual funds. So what is my objective? On that basis, I am going to see the characteristics of that particular investment option. Then marketability. Marketability means whether we are able to sell out our asset in the market or not. Simple example, we do investment in bank accounts. Whether we can sell out bank account in the market? No. So bank account is highly liquid, but it is not marketable. Or when we say we are going to have PPF account, PPF investments or insurance schemes, these schemes don't have marketability. We cannot sell out these schemes in the market. So marketability in the sense whether we are able to sell out that particular asset in the market or not. Like mutual funds, there is a secondary market, we can sell out. Equity shares, there is a secondary market that we are going to sell out our shares. So basically, when we look for marketability, whether that asset will be sellable in the market or not. Then next is capital growth. When we speak about capital growth, means we are looking for capital appreciation out of investment, as it is also one of the greatest quality of investment, whether we are going for a capital appreciation or not. Capital appreciation means sometimes like we do investment in PPF. That is not going to give you any regular income, but if after 15 years your PPF account is going to get matured, you are going to get a good lump sum amount. And whatever amount we are going to get, that is the capital appreciation. Suppose today I am going to put 100 rupees, 20 years I am going to do investment, maybe after 20 years I am going to get an amount of 130 rupees out of investment. So what difference between 100 and 130 will be that 30 rupees will be my capital growth or capital appreciation which I am going to generate out of my investments. Then it is always person to person that what type of investment they just want to go for. As some people want there should be a regular income or capital appreciation, some want just capital growth, and some look for only regular income. So what is the priority or what is the basic objective of investment? On that basis you are going to take that particular decision. Then next, purchasing power stability. Purchasing power, it is directly linked with your inflation. We know what is inflation exactly. Inflation is the reduction in the purchasing power and increasing in the price of product and services, which generally reduce the purchasing power of individuals. So whenever we are going to do any investment, we look for at least a minimum rate of return which we should get so that we can cope up with the inflation rate what we are going to have in the economy. So whenever we are going to do investment, maybe if inflation rate is 7% or 8%, we should look for an investment option which is minimum going to give us a 6 or 8% return so that we are able to cope up with the inflation. So purchasing power stability means at least we should go for selection of an investment avenue which will help us to meet the inflation component which is going to give us the minimum rate of return which is required to cope up with the inflation. Maybe today if I can purchase a particular product at 100 rupees and after 2 years it will go to 110. So I choose investment in such a form that at least after 2 years if same product I am going to choose, I can have same purchasing power. Means I can have a 10 rupees return on my 100 rupees investment in 2 years. So that is the purchasing power stability, means we want to retain the purchasing power due to the factor of inflation. Next is stability of income. As I said you, like when we look for investment always depend on the risk tolerance of an individual. And the people who are going to take more risk, they can have more income expectation. But few people look for an investment in which maybe the risk component is not that much, maybe moderate or low, but there should be a stable income out of your investment that you are going to do. So that is a stability of income. Like when we do investment in your PPF account, we know if government is going to promise 7.9% in the PPF investment, definitely that amount of return I am going to get out of my investment. But suppose if I will get investment in the equity shares, maybe I can get 13%, maybe I can get 15%, maybe I can get 8% also. So that stability is not there because risk is too high of systematic factors. So we say when we look for a stability of income, we should choose the investment options according to that only. Next is tax benefit. It is also a very important component of investment avenue selection. Tax benefit, because as we know under Income Tax Act 1961 we have several sections under ATC, ATC-CD, and which provide us a great amount of tax exemption if we are going to do investment in certain specified clause of avenues. Like if suppose I am going to put my money in PPF, I can avail the tax exemption. Suppose if I am going to take a property or home loan, then I can avail that tax exemption. If I am going to invest in a insurance scheme which is going to provide me a tax exemption, I can avail that tax exemption. So sometimes if your income is going to cross the exemption limit, you go for investment so that you are going to get a return also and you are going to get the tax benefit also. So it can be also characteristics of investment which we are going to look. So now we have discussed all the characteristics of investment. So if we are going to have a selection of investment options, all options are going to have few of these characteristics, one or two or a few characteristics you are going to find in all the type of investment. Like suppose if I will take insurance, maybe insurance I can target for getting a certain amount of return, for risk management, and for tax benefit also. Maybe suppose if I am going to do investment in particular FDs, maybe I am looking for a stability of income and I just want to go for safety. And if suppose I'm going for investment in equity shares, maybe I'm looking for a marketability, maybe a capital growth. So risk component will be also in there. So these all are the characteristics of investment which we have discussed. So today we have seen the concept of investments and the characteristics of investment. So thank you all for the patience listening, and in next session we are going to cover the further objectives and process of investments. Thank you.